Over the years, I've had lots of questions about how you balance short-term and long-term investing. And I'm going to try and explain to you today why I think short and long-term are both really important and how dangerous it is if you overlook short-term risk in portfolios. Of course, I completely understand why people think long-term returns are important, and they are very important. But if you're not taking care of the short term, you risk completely derailing your portfolio and ending up in a position where you can't benefit from the long term. So by this, I think the problems come from three areas. So if you have too much risk in your portfolio, the first is that if your attitude to risk isn't high enough and your psychological ability to cope with your lifetime savings reducing in value, you're quite likely to want to exit an investment while it's losing money before it has a chance to recover. Secondly, it may not even be something that's coming internally from you. It might be somebody in a smart suit and tie who comes to you and says, well, you need to sell this poor investment that you've got and you need to buy something that works better for you. Come over here to this other thing that I have. And the effect of that, of course, will be that you'll sell your investment that's lost you money and buy another investment that probably has lower returns, but in the short term has performed better. So in both of these situations, you ended up unwittingly selling out of your investment before it has recovered and crystallizing the losses forever. The third reason is more technical, but actually very important. And that is if you're in retirement and taking income, volatility isn't just unpleasant, it actually directly leads to a lower return. In fact, we've looked at it and we know that if you have a high volatility portfolio in retirement, even if you have the same long-term return as a lower volatility investment portfolio, you will end up with less money and therefore more risk of running out of money in retirement. So those three reasons all mean that it's very unlikely any investor who exposes themselves to too high risk will end up enjoying the rewards of what they expect to be better returns. Hopefully I've convinced you that risk is really important, but of course return is also important. So what you're looking for is risk-adjusted return, how much bang you get for your risk buck, and this is what gives you a measure of how well the portfolio you have is working for you and how much it improves your chances of meeting your objectives. So today, if you're going to manage risk, I think there's two ways that you do it within a portfolio. One is intelligent diversification. By intelligent, I mean looking at what the risks are that are likely to derail a portfolio and building robustness within the portfolio to protect you. So today's risks are economic, like a recession, inflation, interest rate risks, well, obviously interest rates have gone up a lot, and event risk, things like oil price shocks. So ideally in a portfolio, you have investments in there that will benefit, that will take it as an opportunity to the same event that's a risk and a cost to the rest of the portfolio to balance the whole out and give you a smoother return. And this will change over time, which is why I call it intelligent diversification. The second factor is more tied into returns, and it's really avoiding mistakes. So avoiding areas of investment where you're not being paid for the risk that you're taking. So today, high yield or junk bonds, the yield premium over government bonds isn't high enough in my view, and at some point it will be a lot higher, and I'd rather buy the bonds then than buy them now and run the risk of losing money during that transition. Secondly, areas of the stock market that are very expensive. It's never sensible to buy these heavily buy them, in my opinion. Of course, having some of them within a portfolio is helpful for diversification, but to overexpose yourself to areas of the market which are too expensive relative to their history really leaves you vulnerable to those investments coming back down to the average and you losing money. Today's video's really all been about risk-adjusted return and why that's important. Today I've gone into detail on the risk. Next month I'm going to go into more detail on return and how we use a similar framework to the one we use today to actually improve returns as well. As always today I've been talking about investing, so please remember your capital is at risk. If you have any questions about what I've been talking about, don't hesitate to get in contact with me. If you like it, I would love it if you pressed like on YouTube. That really does help us to improve visibility. And if you're not subscribed to us, just click on the flying colours icon and you'll automatically be added to the list. Thank you.